Minister Sir Keir Starmer faces mounting political pressure over his handling of a scandal. Peter Mandelson's links to convicted sex offender Jeffrey Epstein. Well, let's get into some of this market direction as we gear up for the Bank of England decision. Simon French joins us, Chief Economist, Pamela Liberum. I thought we would kick off talking about some of the inflation implications for the central bank as we wait for this decision. But it feels as though the gilt market is looking at other factors this morning, the political implications if we're talking about a change at number 10. Just weigh in on that.
So I think you're right that gilts are really looking, particularly at the long end of the curve, on what might happen politically in the UK rather than in terms of monetary policy. And we've seen this morning yields move out on the 10-year, up about 7 basis points and up about 10 basis points since what was quite a crucial parliamentary question session for the Prime Minister yesterday. And that move took place at the time when treasuries and bonds have been flat. So it's quite an asymmetric UK move, which tells you that investors are saying, well, we may see a leadership challenge come. I think most of us expect a leadership challenge in Q2. It may come as early as Q1. And the victor of that is likely to mean more issuance, more inflation, and how do we price that across the curve? We probably push yields higher.
We did see back end of last year the market had some dangling questions about the commitment to budget discipline under Rachel Reeves, if there happened to be any change at number 10. But do you think the Bank of England's actively going to be talking about some of this political situation at all today and implications?
Not this meeting, but roll forward 3 months to their next quarterly meeting when the market is pricing in the cut. The market isn't pricing in a cut today, but is pricing in a cut in Q2. That comes a week before the local elections in the UK. Normally a sort of fairly low profile political event, but that could be the catalyst for political change. And so while I think the Bank of England probably get a bit of a free pass on talking about politics this time round, I think roll forward 3 months and they're going to be right in the crosshairs of what is potentially quite a different fiscal policy and political setup in the UK.
Well, let's just talk about price stability in the UK, because that is what the central bank will be talking about. And in the back end of last year, we did actually see a pickup in some parts of inflation. Airfares, for instance, was one of the features. Market thinks it's going to slip back and will go back on trend in terms of seeing a pullback at inflation. Is that necessarily the case? Do you have any concerns about price stability from here?
Oh, I definitely have concerns on price stability, but there's no doubt that actually inflation will come down from here, and particularly in the crucial April print. April is always a really important print for the UK, but like for US investors, January is the important CPI print. For April, a lot of prices are indexed in April. We expect that to come down quite aggressively because the energy price cap, which regulates household energy costs in the UK, will come down about £100 to the average household, but also some regulated prices. The Chancellor, the Finance Minister here in the UK, made interventions back at the November budget to lower those prices. So we expect inflation to go down to 2.4% in the second quarter. My worries, though, are how sustainable is that move, because those feel like one-off effects.
You make a point that you think UK monetary policy remains restrictive.
Yes.
How negative is it to have a restrictive backdrop on monetary policy when others are, like the ECB, for instance, are at neutral? Well,
it's inevitable if you haven't hit your inflation target, and you actually haven't hit your inflation target by quite a lot over the last 12 months. If you look at the bump in UK inflation in the middle part of 2025 as a result of tax changes, employer national insurance contributions were a big contributing factor. That meant that the Bank of England had to remain restrictive, couldn't go to neutral. Contrast that with price levels in the Eurozone, where they're back sustainably on core measures and headline measures close to 2%. That means they can move to neutral. It's going to be a while, I think, before the MPC feel confident to move to neutral, which we think is about 3.25%.
Something that hasn't dissipated anywhere is services inflation. I mean, even the ECB close to target later on today, they've still got a services inflation problem. We're seeing it in the UK as well, from hotels to airfares. 4.5 from 4.4 in November was the latest number we got. That seems like it's still going to be one of those issues still to tackle. We'll park that there just for the minute, because we're waiting for this decision to hit the tape. And of course, when it comes to those expectations, 3.75% is the rate, and we are unchanged today as the decision has just hit the tape. The split here, the 7-2 split is what the market has been looking for. As you can see, the ultimate reaction on markets today is that we have had sterling declining. We're 6.2% down at this rate. Just get a couple of lines here in terms of what's just crossed. The policymakers, Breeden, Dhingra, Ramsden and Taylor, voted to cut rates by 0.25 percentage points to 3.5%. So in terms of that split, there has been 5 unchanged, 4 voting for a cut. So a 5-4 change is what we've now seen in terms of that voting split versus the 7-2 anticipated. Before I get to any other lines, Simon, do you want to weigh in on that?
Yes, surprised that Sarah Breeden and Dave Ramsden, the two deputy governors, voted alongside. We knew that Swati Dhingra and Alan Taylor would vote for a cut. For it to be so close to 5-4, I think the reaction of Sterling going a bit softer is likely to, if you like, crystallise the idea that the Bank of England will cut in the spring. Timing of that, whether it's the April 30th MPC or into June, I'm not quite sure, but I certainly think that was a more dovish stance in terms of the vote setup than the market was expecting. Yeah,
I'm just going to throw a couple more lines and feel free to jump in at any point. Andrew Bailey saying, all is going well. There should be scope for some further reduction in the bank rate this year. Says does not mean I expect to cut bank rate at any particular meeting. So again, clarity on the timing, that it's still up in the air. He expects the CPI to fall to around 2% in spring. Need to ensure it stays there so that it's anchored. CPI return to 2% target on a calendar quarter basis in the third quarter of 2026. November forecast, we're saying second quarter 2027. Is that significant as we're talking about a pull forward in terms of that?
It is. Look, it's a big monetary policy report which we'll have to work through, but the headline on that is actually that it hits the inflation target in Q3, which is somewhat earlier. Now, I'd be interested to see there have been a couple of conditional assumptions that have moved around quite a long way since the Bank of England last forecasted. Gas prices, although they've spiked quite a lot in recent days, actually came down for most of the last quarter, so that's a disinflationary impulse. Also sterling. Sterling, although it's down on the day, is actually strengthened certainly against the dollar and strengthened on a trade-weighted index. That mutes imported inflation as well. And it feels like, just looking at those headlines, that the Bank of England will have factored that into its forecasting model and come up with hitting its target somewhat earlier, hence perhaps what moved those two deputy governors to move to a rate cut vote rather than holding. Yeah,
a couple more lines here. The Bank of England monetary policy report, risk of greater inflation persistence has become less pronounced. And when it comes to the MPR saying some downward inflation risk from weaker demand and looser labour market remain. Yeah. Now, when it comes to the labour market, one of the biggest features has been AI. The market is looking at how disruptive that could be. A lot of the labour market recruitment experts are saying, look, there are cyclical factors that you're seeing a lot of economies that's impacting the labour market. It's not necessarily AI at this stage. Yeah. But earlier this week, we had the very disruptive impact of Anthropic. And the market was saying, look, that could just be a precursor to some sort of massive wave across the jobs market in terms of disruption. Yeah. Do you think, how are you thinking about the labour market and whether it could be upended this year?
So I tend to agree with what you're hearing from the recruitment sector, which is what we're hearing as well from the listed recruitment sector, which is, for now, it's national living wage, employer national insurance, the employee rights bill. These are legislative and tax burdens on employers that are meaning they've shed labour since really the middle part of 2024. And that is driving the UK employment rate lower and the unemployment rate higher. Now, you're absolutely right. On a medium long-term basis, the big threat here is disruption and structural unemployment from obsolete skills. But to see it in the data right now, we haven't seen it in the productivity data, we haven't seen it in the unemployment data. It might be the future story, but let's be honest, the central banks, the Bank of England included, are guessing like the rest of us on how disruptive that will be to labour supply matchup. Yeah.
Let me just dig out some of the actual CPI numbers. The BOE forecast shows CPI in 1 year's time at 1.7%. A November forecast, just to remind the audience, was 2.5%. So that would take us below the 2% target, effectively at 1.7% in a year's time. In 2 years' time at 1.8%, again, below the November forecast of 2%. So at 1.8%, below target again in 2 years' time. In 3 years' time at 2% versus 2.1%. So now we're talking in the near vicinity of 1 and 2 years' time frame that we will be below target of 2%. Yeah. What does that suggest in terms of a rate cutting cycle?
It suggests that I think markets can firm up the idea of this being a year of rate cuts, and probably the 2 or 1.5 that was priced in before today, and probably 2 by the end of today, I would suspect, based on this report, is right. But going further, would mean effectively saying that such an output gap has grown that we actually don't need to go to neutral, but we probably need to come to quite an accommodative stance. That would be quite a damning verdict, quite a difficult one politically for the government to absorb, for the Bank of England to say, look, you've made such a mess of the growth agenda that we're having to move monetary policy to an accommodative stance because actually growth is so soft in the private sector. The fly in the ointment here is PMIs, and we had the construction PMI out first thing this morning from the UK, another beat after the manufacturing and services PMI. Actually, the cyclic indicators are turning upwards. So is it possible that the bank are underestimating underlying resilience of demand? I think that inflation forecast may suggest they are.
There's been a lot of excuses about the growth profile and whether some of that's been emanating from offshore tariff policy, uncertainty, macro events, geopolitics, every excuse for pretty much every leader, including for the UK. And the UK would say, look, we did a ton of trade deals and that's been positive. On the growth forecast, though, we're now for 2026 at 0.9%. That has been shuffled down from 1.2% in these forecasts. When it comes to next year, 1.5 versus the 1.6% that we're at, and by 2028, 1.9 versus 1.8%. So you point around lower growth. Then just rounding out the employment side for some of these forecasts, Q4 of 2025, 5.1%, Q4 of 26, 5.3%, Q4 of 2027, 5.3%. So those are the adjustments that we're working with. On the growth side, how disappointing is it when we're talking about the politics of the day, we're talking about an economy that badly needs growth in a huge technology transition? What do you make of the growth?
Well, 0.9% is a pretty poor rate of growth. It's less than half the average the UK has had over the last 30 years. But it is consistent with a really sluggish recovery since the end of the pandemic, some pretty big cost headwinds. As it happens, and we're a bit more optimistic than the bank, we think 1.5% growth. And actually, if you look at the UK, it has shown remarkable resilience. The consensus from independent forecasters, including the Bank of England, each December prior to the year ahead, has underestimated growth in 2022, 2023, 2024 and 2025. Will it do it again in 2026? Because consensus is around 1%. I think it will. That's not a celebration of public policy. It's just a celebration actually of resilience of UK businesses. Given everything that is thrown at them, they managed to still churn out growth. But it's what could be if we sorted out our capital markets, our energy markets and our labour markets, which feel like some quite costly burdens on getting to what the government targets, which is the fastest sustained rate of growth in the G7.
It's a long wish list on that agenda you just threw at me. Thank you so much for helping me out. It's been eventful for what was expected to be a fairly quiet decision today. There was a lot happening, Simon. Thank you so much. Simon French with us, Chief Economist at Panmure Liberum. Well, let's get out to Ritika with more from the Bank of England. Ritika, the vote split, the adjustments to growth, CPI, weigh in.
Yeah, well, I've been pouring through the details, of course, Karen, during the lock-in. As expected, the MPC voting to hold rates steady at 3.75%. That was as expected. What was more interesting, though, was the divide that we saw on the committee. We were expecting to have a 7-2 vote in favour of holding. We actually got a 5-4 split, so much more narrow than expecting, again, suggesting the divide on the committee. Now, on balance, the committee does see the risk of greater inflation persistence is less pronounced, and that the bank rate is likely to be reduced further. Where they differ is both the timing and the extent of those cuts. Now, while they see inflation returning to the 2% target by April this year, in part helped by measures of the budget, there is caution around the sustainability of the return to 2%. And of course, key to that puzzle is the wage growth as well. Now, of course, they are weighing up the inflation outlook with the weaker demand side, the weaker labour market. That's the other side of the equation. They see growth, as you were talking about, slowing to 0.9% by year end, and an unemployment rising to 5.3%. Also a savings ratio jumping to 9.3% by year end. There were no changes, Karen, on the overall guidance. Still suggests rates on a gradual downward path. But again, it goes back to the timing and the extent of those cuts.
We have seen an interesting move on the gilt market in the wake of the decision. So Bailey almost leaning against Mandelson. We had a Mandelson spike on the gilt market this morning that, look, the blowback for Sir Keir Starmer could be big enough to see him removed from number 10 in terms of his handling of the situation. But that rise that we saw at the 10-year this morning has been counteracted by what is almost a dovish tilt in some quarters of this forecasting from the Bank of England. Do you want to just pick up on that and some of the political story, how it's been assessed by the central bank?
Yeah, Karen, somewhat overshadowed the Bank of England decision to an extent this morning, because given we are talking about the timing specifically of a rate cut, you'd be remiss to ignore all the domestic political uncertainty going on right now, particularly in the run-up to the May local elections. And that, of course, seems to have intensified over this saga, this latest saga over Mandelson. And I think that the question is whether that would play into any decision on when it comes to the timing of the rate cuts. We have seen the impact, of course, as you mentioned, on the gilt market, because we know that uncertainty that can cause depressed demand. The question then becomes, does the Bank of England get ahead of that and cut rates ahead of those local May elections, or does it wait and see how things play out? So, of course, the Bank of England's not necessarily going to talk about that. There was nothing to that extent mentioned in the lock-in period, but it is a question that I'm sure is on a lot of investors' minds.
Ritika, thank you very much. The wash up here now, the money market's pricing in 50 basis points of rate cuts by year end, up from 35 basis points before the Bank of England statement. There's going to be plenty more coming your way. Andrew Bailey will begin his post-decision press conference at 12:30 London time. Don't miss that streaming as part of Decision Time on the CNBC International Live YouTube page. And there's plenty more central bank action coming away on CNBC. From 1 p.m. London time, I'll bring you coverage of the ECB's decision. Thanks for tuning in. That's all from Bank of England Decision Time. I'm going to hand you back to our colleagues stateside.
Hi, everybody. Welcome. Thanks for being here. Welcome to the February Monetary Policy Report press conference. With us today, we have Claire Lumberdelli, Deputy Governor for Monetary Policy, Dave Ramsden, Deputy Governor for Markets and Banking, and the Governor, Andrew Bailey. Andrew will begin with opening remarks, and then we'll turn to questions.
Well, thank you, Katie. My main message today is one of good news. Disinflation is on track and looks to be ahead of the schedule that we expected in November. CPI inflation has fallen from 3.8% in September to 3.4% in December, which is a little lower than we expected back in November. And we expect inflation to decline further to about 3% in January, February and March, before reaching a level close to the 2% target from April, and we think then staying there. So that point of reaching near to the target is about a year earlier than we expected when we were last here back in November. As inflation has fallen, we've been able to ease our foot off the brake, making monetary policy less restrictive by cutting bank rates 6 times, including at the meeting we held in December. Recent developments provide more confidence that inflation is on track to return to the target soon. But we need to ensure that inflation falls all the way back to the 2% target and stays there. So today we've held bank rate at 3.75%. Now, despite all the uncertainties in the world, and we don't underestimate those, we are not currently facing a situation in which monetary policy is being hit by big new shocks. The world economy was more resilient last year than we had expected. So our course remains the same. It's to get inflation to the 2% target and for it to remain there and to put the big external shocks that drove inflation up behind us. This means that with inflation returning to target, there should be scope for some further easing in monetary policy. But risks remain, and the MPC's policy decisions will be shaped by how they unfold. On the one hand, the period of high inflation could have affected the way wages and prices are determined in the economy, creating more persistent inflationary pressure. On the other hand, weaker labour demand and subdued household spending could push inflation further down. Monetary policy is being set to balance these risks. So I will now turn briefly to the near-term outlook for inflation before setting out the 2 key policy judgments underpinning our approach to setting interest rates. Chart 1, which has just come up, shows 12-month inflation in this Consumer Price Index since the start of 2024. That's the white line, along with its components. Those are the coloured bars. CPI inflation remains above the 2% target, reflecting in part unusually large increases in administered prices and food prices. Elevated labour cost growth has also pushed up inflation, particularly for services, which remain the largest contributor to headline inflation. That's the yellow bars. But the shaded area in the chart shows how we expect inflation to fall to a level close to the 2% target in the second quarter of this year. A fall in the contribution of utility prices represents around 1/3 of the overall expected decline in the first 6 months of this year. A reduction in the contribution from other administered and regulated prices and indirect taxes is also expected to support the fall in inflation towards the target. And the fall is further supported by a broad-based slowing in cost pressures, including from lower wage growth and a fading impulse from last year's increase in national insurance contributions for employers. Overall, the fall in second quarter is 0.7 percentage points larger than we had expected in the November report. As Chart 2 shows, that news largely reflects the energy measures announced in the budget, which, alongside a fall in wholesale gas prices, is expected to result in a decline in the Ofgem price cap in April to just over £1,600 from the current level of £1,758. While we can now be more confident that inflation will fall back to around the 2% target in coming months, monetary policy needs to ensure that inflation will stay close to the target sustainably. So that takes me to our first key policy judgment. that the risk from greater inflation persistence has continued to become less pronounced, while some risks to inflation from weaker demand and a loosening labour market remain. The recent experience of high inflation could still be affecting wages and prices. This could create more persistent inflationary pressure, requiring tighter monetary policy than otherwise. Services price inflation and wage growth still need to fall further for the MPC to be confident that inflation will return to the target and stay there. In addition, weak productivity growth could put upward pressure on companies' costs. But the evidence suggests that this upside risk to inflation has continued to diminish. Lower inflation in coming months should feed through into lower inflation expectations among households and businesses, reducing the risk that inflation expectations will add further to inflationary pressure. And while wage growth may only be falling slowly, new bank staff analysis provides reassurance that structural changes in wage setting will not keep adding to inflationary pressures. As Chart 3 shows, annual private sector regular pay growth, that's the blue line, slowed to 3.6% in the 3 months to November, down from 4.4 months in the 3 months to August, and a little below our November projection. Looking ahead, the Agents' Pay Survey, that's the pink diamond, suggests that pay settlements will average 3.4% over this year, down from 4% last year. With a looser labour market and falling inflation supporting a fall in inflation expectations, we expect actual pay growth to fall somewhat below current expectations for pay settlements, to about 3.2% by the end of the year. That is close to bank staff estimates for a level of pay growth consistent with the inflation target. Supported by the cooling in labour costs, we expect services price inflation to ease from 4.5% in December to 3.3% in June. Risks to the outlook for inflation from weaker demand and a loosening labour market do remain. Labour market conditions have loosened further, and bank staff estimate that underlying employment has been flat over the past year. The rate of unemployment has risen to 5.1%, and measures of recruitment difficulties have eased. While the bank's agents report that firms are managing headcount mainly through natural attrition, the redundancy rate has ticked up in the official data. UK economic activity remains subdued, especially in market-facing sectors. Bank staff estimate that underlying GDP growth, abstracting from volatility in the headline measure, was 0.1% in the fourth quarter of last year, slightly lower than both headline GDP growth and estimates of potential supply growth. Contacts of the agents continue to expect subdued growth throughout the year, citing weak confidence and subdued global demand. In the central projection, GDP growth is expected to strengthen to nearly 2% a year by 2028, underpinned by a recovery in consumption and a strong housing market. But there is a risk that consumption growth will be slower than we expect. Despite past reductions in bank rate, the household saving rate remains above historical levels. Now, that could indicate that household spending growth will remain weak as households are more cautious following the recent shock to their finances. In turn, weaker demand in the economy could further weaken the labour market with larger rises in unemployment. Spare capacity could build to such an extent that inflation could settle below the 2% target unless monetary policy is loosened further. That said, there are also upside risks to inflation in the period ahead. The near-term fall in inflation might not affect inflation expectations and through that wage growth to the extent that we expect. There may be less slack in the labour market than our current estimates suggest, and structural changes in wage and price setting could still assert themselves. And productivity growth may disappoint relative to our expectations and generate greater inflationary pressures. But overall, concerns about upside risk from greater inflation persistence continue to become less pronounced, while some risks from weaker demand and a loosening labour market remain. That takes me to the second key judgment, that, based on the current evidence, bank rate is likely to be reduced further. but judgments around further policy easing will become a closer call. As always, the extent and timing of further easing in monetary policy will depend on the evolution of the outlook for inflation. On the one hand, cutting in bank rate too quickly or by too much could lead to inflation pressures persisting, requiring policy to change course. On the other hand, waiting too long to ease policy could come at the cost of a sharper downturn in activity and subsequently inflation, requiring greater policy easing to ensure inflation returns sustainably to a target. The central projection described in the Monetary Policy Report provides a reasonable baseline for how the majority of the MPC judges the economy is likely to evolve if neither of the remaining risks around inflation persistence and demand weakness materialise to a meaningful degree. As shown in Chart 4, in the current 3-year projection for inflation, which is conditioned on the market path for interest rates, inflation falls to around the 2% target in the second quarter of this year and then remains close to that rate over the forecast period. The effect of the budget measures on the central projection is shown in Chart 5, along with underlying drivers of the deviation from target of our medium-term projection for inflation. The contribution from administered prices and costs related to national insurance contributions are assumed to dissipate in the second quarter of this year. That's the blue bars. Lingering second-round effects on wage and price setting from the big global shocks of recent years, that's the purple bars, also fade and largely dissipate by the middle of next year. In part, reflecting the restrictive stance of monetary policy, a margin of slack widens a little further in the near term and weighs on inflation throughout the forecast. That's the green bars. While monetary policy continues to weigh on inflation and activity, with the progress that we've made on disinflation, we've been able to make monetary policy less restrictive. And if the economy and the outlook for inflation evolve as we expect, there should be some scope for further easing in monetary policy in the period ahead. But for every cut in bank rate, how much further to go becomes a closer call. As always, the MPC remains squarely focused on our remit to return inflation to the 2% target sustainably. So with that, Claire, Dave and I are happy to take your questions. Thank you.
Let's go Sam and then Helia, please.
Financial Times. There have been some activity indicators, particularly PMIs, which have been a bit stronger of late, but you don't seem to be putting any particular weight on that. Indeed, the outlook is very subdued, as the minutes suggest. I wondered why you're not seeing any more promising signs from those activity indicators. And given the very weak outlook, and given you have inflation below target on both a 1 and 2 year horizon, why aren't you cutting today, or why was there not a majority in favour of a cut as soon as today? Thanks.
Well, I'll start off. I think on activity, it's interesting. You're right. I mean, there's a bit of a tension in there that the surveys are beginning, as you say, Sam, to show some signs of an uptick. On the other hand, as you'll see from the report, the message we're getting from the agents, I mean, they use the word lackluster, I think. So now, let me put that into context because, you know, we've been going through a lot of years of very big shocks. I would describe this sort of tension in the data and the evidence as sort of something that's, you know, quite usual, actually. I mean, in the very short run sort of view of the government. But of course, we'll be very focused on it. I don't want to say usual in the sense that we're not in any sense focused on it. We will. It is something we will be looking at very hard in the next meeting, and no doubt the ones after that. So there is a little bit of a puzzle in there, I think, which we'll be seeking to solve. Now, on the question of why not cutting, I mean, first of all, I would say that obviously, as you can see from the chart we've got in front of us, inflation does dip below target on the central case, but it actually, you know, it's only a small dip and it comes back to target. But actually, the bigger point I'll make at this point is that because you asked the question rightly about how that conditions our judgment today, we need to see this pattern emerge, and we need to see more evidence, in my view, that we're going to get this sustainable return to target. And that really is an issue about what I call underlying inflation. We've got obviously quite a few things going on, which, as this chart shows, are special measures. Just as, by the way, we had that last year when we had what we tended to call the hump. That's the data, not our feeling towards it. And we are seeing that now in wine. But we have to be very focused on the underlying story, because that's what, in the absence of, of shocks to come, which we don't know about, that's what's going to determine this path. I don't know if we have to add anything.
No, nothing else coming up. I mean, the only thing I was going to say, although there's been a vote this time, and we voted in different ways, and you can read about that in the paragraphs. We're all balancing these two risks to underlying inflation, as Andrew emphasised. So, for some of us, there's still the worry about persistence, that inflation won't settle at the target, but will stay above it. And for others of us, the downside risks are more apparent, so the worry is that inflation will actually settle below target. But we're balancing those two risks, which has really been a pretty consistent picture.
I would say if you look at that picture of mixed data is true across the data sources, survey, more administrative data, what we're hearing from the agents, those sorts of things, but also actually kind of within types of data. So if you look at the wages data, for example, there's some indicators that are stronger, some of the surveys, some of the more estimates based more around the relationships we've seen in the past are a bit weaker. So you're not just seeing, it's not that each category of data, they're not consistent with each other, but also within, there's quite a lot of a mixed picture, which in a sense gives you a sense that, there's not things strongly one direction or the other at this point.
Helia, in the middle there.
Helia Ibrahimi, Channel 4 News. Just to underline that, really, because people at home will watch you saying this is good news, that we are going to hit our inflation target in April. And they will be thinking, well, hang on a moment, why don't you get on and start cutting, especially when unemployment is going up and growth is slowing? At what point do those risks become more dangerous for the wider economy?
Well, it is good news. I mean, this picture is good news, but there's a lot of assumptions lie behind this picture. Not so much in the short end, but the left-hand side of it as we're looking at it, because a lot of that, as I say, is measures that have been announced. But our job is to keep it sustainably at target, and there are a lot of things that we need to see evolve for that picture to be as it is in this chart. Now, I think it is good news. I'm optimistic. But certainly I'll speak for myself. I need to see some more evidence that we're on that path before we could make another cut in rates. And let me give you one illustration of that, which is a bit more concrete. We have got expectations of inflation which do remain elevated, both in households and businesses. Now, I would expect, based on patterns of history, that as we start to see, and it comes through in the data, this pattern of inflation coming off, and we do expect some of that to be seen in the next release. Actually, we do expect it to move down in the next release. Now you can see that on the very far sort of left-hand side of the shaded part. That will feed through into expectations, because that's the way it normally works, and that is something that will certainly give me greater confidence that we're on track, and that's what we think we need to see to take any further step at this point. So that's what I'm waiting for. But you'll see in the paragraph that I wrote that I expressed it very much, is that as I go into the next meetings, that will be the question I'll be asking myself.
And I think it is important. The reason we put this chart up and we're emphasising what's going to happen to inflation, not so much in the very short term, but where inflation is settled, is that is our remit. So we're very conscious right across the committee that unemployment is now above 5%. That's 1.8 million people. But we have to think about what is the impact of what's going on with subdued activity with the labour market on inflation. So we're balancing those risks around inflation.
Paul, up at the back there, and then Sue.
Paul Kelso, Sky News. Governor, too, if I may, you say further rate cuts are now likely. Is the message to borrowers, homeowners, mortgage holders, this is now a question of when, not if? And a second question, if I may, away from today's decision. We've seen revelations in recent days about Peter Mandelson's conduct while business secretary. His contacts with Jeffrey Epstein, the sharing of sensitive information with financiers at a time when governments and indeed central banks were working to deal with the fallout from the financial crash. You were at the Bank of England at the time. Have you got any reflections on that conduct and what risk, if any, it posed to the stability of the financial system at the time?
Well, those are two very different questions. On the when and if question, I think that, the view I just reinforce, having the sense comments I've already made, that I do expect, and as I put in my own paragraph, I do think that it is likely that we will see some further move down in rates. I would emphasise the points I made in the opening remarks, that as we get closer to what you might call the sort of the neutral rate, though there is quite a lot of uncertainty as to where that is, these decisions become a closer call, because that's, this is the question of what's the rate that will essentially settle in, absent further shocks. What's the rate that will cause this profile to settle at target, which obviously is where we want it to be. So there's a lot of uncertainty there still. But my central view, as I said in my paragraph, is reasonably aligned with the picture we've got in front of us. For me, it's then waiting to, I do need to see some more evidence, as I just said a moment ago, that is evolving. Well, look, I'll turn to your second question, Paul. I mean, I am shocked by what we're hearing. You probably remember that around a year ago I had to go and give evidence in a legal case involving this whole issue, dating back to my time at the FCA. I'm afraid all I can conclude is that I was obviously very happy to do that. It's my duty. That again, it was having to sort of, in a sense, push back on the lies that we were being told consistently. I am shocked by what we now learn about what went on during the financial crisis period. But look, let me just offer two reflections. One really reinforces what I think the Prime Minister said this morning, that the most important thing in all of this is the victims. Everything else is obviously things that necessarily must be gone into, but we must not forget that the most important thing in this is the victims in all of this. The second thing I'll just offer, and I think this is, if you don't mind me saying, I don't want to sound pious, but this is for all of us. How is it that we live in a society in which this happened? And the cover-up happened as well. I mean, those are questions that we all have to ask, which, I think that is a very fundamental question that we have to ask ourselves.
Sue. Thank you. Sue Chan from The Telegraph. Governor, could you just reflect on what you think the employment rights bill will affect the jobs market, given it will bed down over your forecast horizon? And how do you think it will affect the jobs market?
Well, we get quite a lot of, obviously, input when we talk to our contacts and when our agents talk to the contacts around the country. I think there is still a fair amount of uncertainty about how that is going to shape up. So we will continue to watch it carefully. I don't know if you want to add anything.
Yeah, I mean, I think we talk to our agents a lot about this, and they talk, hear about it from firms, because actually the details, firms are waiting to see the details to be able to turn that into decisions about what they will do. But obviously, we've had quite a lot of information and intelligence from firms about some of the other changes that we've seen over the labour market over the last couple of years, and we've been increasing, if you like, we've heard a lot about that, and we've done a lot of analysis of it. You can see some of that in some of the stuff we put out today, actually. But in terms of the employment rights bill in and of itself, I think until there's more detail, we won't be able to understand. It's not reflected in your forecast at the moment, is that right? That's correct. Yeah.
Joel, and then Ritika.
Very much. Joel Hills, ITV News. I also have two questions. Governor, you said that all being well, there should be further scope for for cuts, and that future decisions will also become a closer call as we edge towards neutral. Markets are currently pricing in 2 more cuts, which would take bank rate to around 3.25%. In your view, would that be a sensible level